How do central banks like the Federal Reserve actually influence the economy? Well, they pull strings. They have what's called an interest rate target, which is basically the rate that banks charge other banks when they borrow money from them. When the Fed wants to stimulate the economy, they'll lower this target rate, which makes it cheaper for banks to borrow money. And therefore, it's easier for people to get loans and spend money. The idea is that if people have more money, they'll spend it, which will boost the economy. Conversely, if the economy is overheating and inflation is getting out of control, the Fed will raise those interest rates, making it more expensive to borrow money in order to slow down the economy and bring down inflation. But there's a lag. It takes time for these interest rate changes to filter through the economy. So central banks have to be very careful and deliberate with their moves, because once they set the rate, it's going to take some time to see the effect it has on the economy.